Welcome to the March monthly market report. I'm so grateful for everybody that joins each month for the monthly market report to get the most education on the topics that matter in real estate. I'm going to take you through several things that I think are very, very relevant and very, very important for this market. We're in a time right now where there are a lot of questions, a lot of concerns, and a lot of uncertainty. And my hope is that through this information, that I give you what you need to get some clarity on the market. We need to define reality right now for the market. And if I were to pick a way to do that, it would be this graphic right here. And that defines the reality of the last month in real estate. We started off the year sort of seeing good buyer demand, good activity in the market the first part of February, dip down into the fives. And then as we start to hear more uncertain economic news relative to inflation and other things, interest rates start to climb. And really, that reaction that maybe we're not as far along in the fight against inflation as we thought is causing interest rates to rise. There's other reasons for that as well, but let's just sort of keep it at that right now. And that's caused a lot of panic in the market and a lot of uncertainty in the market. But here's what I would tell you about this. If you think about this, you think about the last 30 days, we're starting to see this range of interest rates. We've got some good news on inflation, and we're there in the low sixes and high fives. And then we sort of get this negative news on inflation, and it starts to send things a little bit higher. And so I think as we define reality right now, I mean, that's basically it. Now, I think there's things that we can do, and I'm going to talk about that here in just a minute. And the thing that we want to do and be aware of is what influences interest rates is the 10-year Treasury. So if you look at the 30-year fixed rate mortgage, this is the same graphic as before, but in a bar chart and a line here. The line being the 10-year Treasury yield. Interest rates are going to follow that, and they follow that straight up over the last 30 days. And the reason for that, I think, we need to understand. Sam Cater from Freddie Mac said it really, really well. He said this. He said, the economy is showing signs of resilience, mainly due to consumer spending and rates increasing. Overall, housing costs are also increasing and therefore impacting inflation, which continues to persist. And so we know that. We know that it's followed that in unison, sort of this symbiotic relationship with the spread between the two of 1.7%. So that really means if you take the 10-year Treasury, you add 1.7% to it, you get the 30-year fixed. So what do we also know right now? We know that the spread between the 10-year Treasury and the 30-year fix has widened. I always like to think of this as a measure of fear. So we go back to what I said before, the average spread being 1.7%. The average spread going back to the first of this year, 2.7%, almost 1% higher in the measure of fear, the measure of volatility in our market. And I think that my job right now relative to interest rates is to help educate people, to help people understand what's ahead and help them make wise decisions. There's still people that are transacting in this market. Sometimes I think that we think as interest rates rise, nobody's going to buy. And people are certainly still buying, but some will look at it and go, you know what? We can't afford. We're not going to move forward. And it will have an effect. I'm not blind to that. But what I do think is we have to understand it, we have to communicate it, and we have to help people make wise decisions. We've talked before about adjustable rate mortgages and buy downs in this market. And I think now those are more important than ever. The thing I think is a bigger challenge in our business, because we will get through this interest rate challenge for sure. But the even bigger challenge that I see right now is inventory. And certainly across the country, I don't think that there's a market that says we have an oversupply of inventory. Maybe some markets have more available homes for sale than others, but the story of the last few years, and certainly through COVID, has been less inventory. And if I were sitting in front of you telling that story right now, I would use a graphic like this. The total listing count going all the way back to 2017. In 2017, 18, 19, then COVID comes right here in the spring of 2020, and inventory starts to fall. And you see that very clear line where it starts to go down. And why is that? Then I can tell the story. So the meaning of home changed. People started working in their homes, certainly going to school in their homes. Their kids were going to school there. They were eating there. They were working out there. Everything revolved around the home. interest rates sank to 2.75%. And people jumped in and said, now we're going to do it. We're going to buy a home. We're going to find our place. We have a different need. And that started to deplete inventory across the country and fueled this market that we've seen over the last couple of years. And so we've seen all these people want to come in and buy and transact in real estate and have a wonderful couple of years and momentum in the market. And we probably haven't seen a market like that in our lifetimes, and maybe never will. And it just depleted inventory across the country. And while inventory has risen year over year, it's still below where it was in 2019. And this graphic right here does a great job from realtor.com showing the active monthly listings in the last 7 Februarys, 2023 compared all the way back to 2017. And I think this is an important point. I want to pause right here for a second to say this. Anytime you're looking at numbers right now, you can't compare 2021, 2022, or even probably 2023. You've got to go back to pre-pandemic times, which were the normal times, I'm going to call it, in real estate. 2017, 18, and 19. And as you see, 577,000 active listings in February of this year compared to over 1 million almost in the years prior to the pandemic. So significantly less inventory across the country, and we know we need more. We know those issues are out there right now. That's the bigger issue than interest rates. We're going to get through the interest rates. Inventory is a looming issue. And oh, by the way, month over month in this country, we've depleted even more inventory. Inventory is down about 6% January over February, most recently. And you see most of these areas, most states, all states really between 0 and 15% down across the country. Not one that you see that's positive or a different scenario. Just about everywhere seeing less inventory relative to what they saw the month prior. Now, I think this is very, very interesting, and I want to take you back to a couple of things, show you a new slide, show you a couple of things that are interesting here. The first piece is the lack of inventory in this country has kept upward pressure on pricing. That's the reason that things haven't spiraled out of control like we saw in 2008. And this graphic right here, we've used it many, many times before on our monthly market report to show single family housing units that have been completed going all the way back to the 70s. And the fact for 14 straight years, we've been below the 50-year average in the number of units brought to market. So when you have 14 straight years of lack of building new homes, then you end up with a deficit. Everybody rushes in during COVID due to low interest rates. You don't have the available inventory, and that causes prices to spike. The frenzy of what we saw, multiple bid scenarios, all those things that happened due to a number of different reasons. But a primary reason would be the lack of available homes. And depending on who you look at as a forecaster, from realtor.com to Moody's, they would say we're undersupplied anywhere from 1.5 million to 5 million homes. And people often ask, what's the discrepancy between the two? And really, it just comes down to how they're evaluating things. You can go check it out and go research either one of these, a particular forecaster, and say, okay, what are they thinking? But the commonality they all have here is that there simply is not enough homes on the market for the number of people that want to buy them. Now, all of this is very, very important because I think people are hearing that. We're undersupplied in homes in this country, and we can say, yes, we are, and give them sort of a background on that. But here's what it leads to, is this graphic right here from Case-Shiller, FHA, and Moody's. How much have same home prices fallen in the country from the peak? So peak really in June of last year through December is the most recent information. And this information runs in arrears because it's same home sales. It's the most accurate. It's not median list price. It's not anything other than what we have, same home sales done in the past, from the peak to the most recent information that we have. And it's fallen 1% from Moody's, 1.6% from FHA, and 2.7% from Case-Shiller. It's not this runaway train of 20% depreciation that some people said was going to happen. It just didn't happen. And a lot of that is simply due to the lack of available inventory, the lack of number of homes that are on the market. Now, I want to cover this question right here, and I put this in for us to talk about on the monthly market report. And it's this question: should I buy a home right now? We've covered it before, but this is interesting. It's being sort of questioned right now. Is it cheaper to rent or should I buy a home? And I want to give you a perspective and some visuals that will help you answer that question. Three things that are important about understanding this question. First of all, rent always goes up. This graphic right here shows a median asking rent since 1988. It's always gone up. Certainly in the last couple of years, it's gone up dramatically. When you buy a home, your mortgage payment remains fixed. The key piece here is rent goes up, mortgage payments are stable. You can bring that stability to that part of the largest expense of everyone in their household's budget. All right. And then the second thing is prices go up. As we look at this, this is the home price expectation survey as of the fourth quarter of this year. And oh, by the way, the little wrinkle there, they're projecting 1.6 depreciation in 2023. It's appreciation after the fact. And maybe you're saying, well, Josh, you can't say prices always go up when in 2023 they're forecasting prices to go down. Well, here's what I would say to that. Most people in the outlook would say, look, we're going through inflation. We'll get through that. Interest rates will come down over time. Well, also here, if you follow this home price expectation survey, prices may come down slightly. And I'm not making light of that, but here would be my point. If you wait for prices, you wait for interest rates to come down, what do you think everybody else is going to do? It's most likely going to be like Black Friday at Walmart. You ain't getting in. And even if you do, you're getting in a fight. That's the bottom line. And I do believe that that's coming. I think that's around the corner. And certainly it's not going to be that frenzy market that we saw previously, but there is an opportunity to buy. And oh, by the way, if you go back the last 30 years, the average appreciation in this country is almost 300%. It's 289% on home prices. So we can say confidently that homes go up in value, rents always go up. You can secure your payment, your housing payment through buying a home, and it's an appreciating asset, okay? So rents always go up, prices go up. And what does that lead to? The third point here is that's a builder of equity. We take the home price expectation survey, we take an average price of $400,000. And, you know, before you guys all email me and say, you know, we can't even buy a bathroom for $400,000. You can use this and extrapolate it out to whatever that means for you. But that's worth over the next 5 years, $50,000 in equity. Much more normal real estate environment, no doubt. But as we look at the decision to buy a home, my job is to help people make powerful and confident decisions, educated decisions, but also show them the facts. Because there are a lot of people right now saying that it doesn't make sense to buy a home. The real estate market's in trouble. Homes are going to lose 20% in value. This thing is going to crash. And honestly, it's just not true. We can bring the truth to the market, to the people that we serve. And speaking of the spring market, I wanted to share with you that we now have available our spring buyer and seller guides. These were just released last week. So go ahead, reach out, get a link, download these. I'll email them over to you. These are great to give you some hyper relevant information on what's happening in the spring market right now. And it's just great resources to help you out. So as always, thank you so much for joining us on the monthly market report. And I can't wait to see you back here next month.